traders, Gary Wagner here, approximately 11 in Honolulu, making it 5 o'clock in New York City. It is Friday, finally, the 28th day of September 2012, and this is the daily report for gold and silver. We have lower pricing in gold and silver, higher pricing in platinum and palladium, but after the incredible day we had yesterday, the kind of correction or selling that we're seeing today to me is indicative of a pretty strong market. Currently off about $6 on the day. As you can see, 1772.21 cash market as it gets ready to close. We have had a low of 1766 and we have had a high of 1784. Silver, as you can see, is currently trading off about 17 cents on the day, putting it, as you can see, 34.45. It has had a low of 34.21, and a high of 34.98, just shy of that real resistance area we've been talking about at $35 per ounce. You know, traders, as we go in towards the end of the week, there's no doubt we have had a most interesting week. When we take a look, we'll start with the weekly and we'll look at a couple other gold charts before we move on to silver today. But when you take a look at the activity over the last two trading weeks, it's quite interesting. Last week, we did make a high that we haven't seen in quite some time, and that was at 88 in cash, 91, I believe, in the COMEX. You can see that right here. The other thing, though, that came in last week was the fact that it opened near the close. Take a look at the low and the high and where it closed. This small body is a doji candle. A doji is simply a Japanese candlestick that has an equal open and close. In this case, very, very close, because you can see it closed slightly higher on the week, but you can see how small the body is. Now, this week, we made a lower low than the previous week and a lower high and still had the doji. Doji in a typical market indicates a potential reversal. In a sharply trending market such as gold, it can indicate a potential reversal, or it can simply indicate an area of consolidation, an area in which the market is kind of resting and is consolidating before moving to higher pricing. We see that a lot when we look at a interim or intraday chart, maybe 60 minutes, 120 minutes, 420, something like that. You will see that as the market moves, it tends to have a burst to the upside, trade sideways for a while, then a burst to the upside, sideways for a while. And that is indicative of a market that's moving up. Let me try to show you what I mean. So what I've done is I've gone ahead, I've put up a 420-minute candlestick chart, and it is in Henkin format. What you can see in this chart, it is an intraday chart, but you'll see these periods where you get these big bursts. Here you do get a slight correction in the market. It doesn't trade sideways, it does trade a little bit lower. Here then, it then moves up, as you can see right here, and this is what I'm talking about. And this is that sideways trading activity right there. You can also see it right here, and you can see it right in here. In other words, the market trades sideways, then moves up. The market trades sideways and then moves up. So that could easily be what we are, in fact, witnessing at this point. Now, I have added the MACD, the Moving Average Convergence Divergence. You can see that right down here. And the reason for adding that is a study that I do look at, and here's what I'm finding interesting. When we look at the MACD today, we saw the fact that it was really going into cross the other day, and you can really see this cross right there. But it now appears as though it's starting to hook back up. And the fact that it's coming in and hooking back up is really interesting, because typically when you see these cross at such a overbought level, you've got a market that really has a high probability of coming down. At the same time, you see that that has kind of changed where it looks like it's going to cross back to the upside. That's something that we'll have to look at through the week. We don't have an answer for it. We simply have something that to me is a unique observation, and we do want to keep that in mind. Now, what I have done is I've converted the chart that we have been looking. It was a daily chart, and I've converted it down to a 360-minute chart. Reason being is I want to really look at the MACD on a shorter term basis, because On a longer term, on the daily and the weekly, it's extremely overbought. But when we look at these shorter term moving averages and the MACD, you can see that it's actually not overbought at all. In fact, it was overbought. This is where we saw the market come down in terms of the MACD. And really what we saw was a sideways market here rather than a market coming down. Look at that. And now it is now crossed to the upside on our shorter term chart. That bodes well for the sentiment that we will in fact see higher pricing in gold next week. And now on to silver. You know, amazingly enough, we did not get stopped out of our trade. We're in at 29.10 on silver. I think that silver has some real substantial room to the upside, but the caveat to that is the fact that it's had some really strong resistance at $35 per ounce. Let me go ahead and try to line it up straight. It typically, if I'm going to draw it, it's not going to be that straight. But regardless, I think it's quite easy to see the fact that you've had real strong resistance here. The market came down. We've got very, very strong support, 33.44, and it has been literally trading within this defined range. It's gotten range bound again. Now, have we seen this before? Quite honestly, we have. You can see that it's range bound here, that it's range bound through this area and here, and to a degree right in here, of course, you get a small correction and then it moves down. But what that is telling me is that this market could in fact be top heavy at 35 on the short term. We've already seen it kind of correct down here, but at the same time, I think that if in fact the market has the ability to really trade above 35, to get there on a closing basis, let me go ahead and compress this so you get a better idea of what I'm looking for, and we can talk about the different areas that I think this market could go to. If in fact we see a break above $35, and this of course is on a closing basis. A closing basis is what's critically important. Let me draw this line all the way across, because you're going to see historically there's some strong fundamental data. And that is, look at this top in here, resistance, and look at this top here, resistance. So we see that it matches. However, let's assume that the market is able to, on a closing basis, move above $35. If it could, and I believe that it should, where is our next real level of resistance? Well, quite honestly, you can see it on a technical basis right in here, just above $37 per ounce. So if you look, there's really nothing historical in between this area right in here, except for this one top. You have no historical data points that would show any other level of real technical resistance except for this top. You've got this market moving straight up and then falling down. You've got very good support here. We can see that right in here. And in terms of it matching, if we draw our line across, you can see certain areas where it does touch upon it. It tries to trade above this point but cannot, and then of course trends lower. So traders, those are the real points that we need to see how silver reacts if in fact it starts to trade above $35. As I said, pretty much clear sailing to 37. But traders, what I want to do today is really take a much more long-term view of silver. And what I've done is taken that same chart that we looked at, the short-term chart, and that's why it's so compressed right in this area. In fact, for the time being and for the purpose of this particular tutorial on where we're looking at silver to go, let me go ahead and remove it. And here's what you're going to see. So when we look at this chart, just straight on, we can see, of course, our real resistance. And you've got another level here at around 36, 37. We've pointed that out. The next real levels, as we move up in this chart, you've got one little top here, but you've got a major top right in here, and this is $42. The key of what we're looking at within silver is we saw such a hard drop when the market came down. If you take a look at this 4-day drop, I believe it lost 25%, gains a little bit, comes down, makes a new low. Then you get the series of triple bottoms along with gold. Gold also had the triple bottom. Forms the base, and then the market begins to move up. it's a pretty logical place for it to stall right in here. So the reason for taking this wide or really long-term view is at some point, I believe, whether the market corrects here or not, even if it corrects in this area and then begins to move back up, I believe that there's going to be a point in which it makes it over $35 per ounce. When that happens, traders, those are the real next levels that I am looking for the market to go at. And then lastly, I kind of want to blow this chart up. It is Henkin format. It's now in daily. And what you can see is we had this correction. We had red candles. The market actually did trade lower, but we are back in the green. And then lastly, all I've really done is added a Fibonacci retracement the same way that I did in gold. And the reason for doing that is going to be quite clear. When we take a look from the low to the high, and we figure this correction here, take a look, traders, it comes to really the 23% retracement level. That is a valid retracement level. And in fact, we could then see it shoot off from there. And we've still had a strong corrective first, corrective wave 2 in the market. This has been Gary Wagner, wishing you, as always, good trading. We'll talk to you on Monday for another daily update and review. Bye-bye.